Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Strategy Update. Today's Friday, August 25th. Well, since our last update, the correction that started right around the beginning of August has continued. August has turned into be a corrective month for the equity markets. Seasonally, we're in that period, late summer, early fall, when seasonality turns negative. And right on tune markets have turned quite negative as well, at least on a short or tactical basis. In this week's update, we're going to look at our proprietary indicators and see that most of the action has been in the tactical or short-term indicators. If this correction does continue into September, which is possible, we could be setting up for a tactical buying opportunity. Let's take a look at our PAS dashboard. And first, we could see no major changes. All the arrows continue to point up. The core indicators also all continue to be in sync to the upside. So we're not seeing any deterioration of significance, at least not at this point, with any of the core indicators. And that's important because it tells us that more than likely this pullback in the market is short-term in nature and not a trend changer. So we'll continue to monitor the progress of the correction, but at this point, we expect this to be, let's call it a bull market correction versus potential beginning of a new bear market. Over on the tactical side, both of our tactical indicators have come back into the neutral status. Let's take a quick look at each of these. First, we're going to start off by looking at our percent of stocks above their 10-week average price. This is a global all-cap universe, so a very large universe of stocks. And what we see is that during the month of August, there's been a significant decline in this percentage. We came in to the month right around 70%. We're now down below 40%. So something like 35% of the global universe was above its 10-week average and now has shifted below its 10-week average in the last few weeks. This indicator is helpful to try to determine short-term risk level and opportunity in the market. So for example, if we look at where we were at the high, which was the high in the market for 2023, we were up near that high risk level. We came just short of hitting it technically, but now we've worked ourselves into the neutral zone. If we look at January, February, prior to that mini banking crisis that hit in February, March, we also were at the high risk level. And during that correction, we did get a drop low enough to get down to the low risk zone. So just very simply, the way we like to use an indicator like this is a higher risk time to buy on a short-term basis. This is a lower risk time to buy on a short-term basis. So if we get a continued drop in this percentage down to ideally 26% or below, that could set up a good tactical buying opportunity. We could see last year at the low in the market in that September-October timeframe, we went well below the 26% level. But again, that did set up a good tactical buying opportunity. Now let's shift to looking at our overbought, oversold indicator. So this is the duration of this chart is for this particular bull cycle as determined by our market model and the buy signal on November 30th of last year up to current. And this is the channel that we expect the market to trade in as long as it remains in a bull market. So we had pointed out in July and the early part of August how the market for the first time hit an overbought level in this rebound in the market. Not always, but typically that does indicate there's limited ability for stocks to continue to push higher. So it doesn't surprise us that we did get a correction back down into the neutral zone. And as you can see now, we're sitting very close to that bull trend average level that where we would expect the market to be in a bull cycle. The question now is, are we getting the pendulum, which oftentimes once we come off of the high risk level swings down and we get a oversold reading? We see that happen very close to it in March during the mini banking crisis. So both of our tactical indicators were up at or near their high risk level. They've come down now into the neutral zone. Typically, we would see some continued movement to the downside. And if that happens, that could set up an opportunity to put some capital to work at a reduced risk level. Now, we're not there at this point, but some continued movement to the downside could get us to that level. One of the data points we track is U.S. investor sentiment as determined by the American Association of Individual Investors. They poll or survey their members on a weekly basis and ask them if they're bullish or bearish or neutral on the market. Typically, individual investors are optimistic and there's more bulls than bears. But we did point out last year just how low these numbers got and how bearish individual investors became during the market decline. If we look at the last 10 years, that was the most bearish that individual investors had become. And not only did they reach that extreme level, it stayed at that level for a fairly significant amount of time, which is rare. And in our view, that's one of the dynamics that set up the rebound in the market. Individual investors usually are more reactive in nature, so we use this as a contrary type of sentiment indicator. When individuals are negative, there's better opportunities. When individuals are positive, generally speaking, the market is richly priced. So if we look at the rebound in the sentiment indicator, got up to the highest point just before this latest pullback in the market. So, right on tune, individual investors finally became positive again, and now the markets are correcting. Well, the latest numbers have moved the sentiment measures back into negative territory, just barely. But if we take this chart out to a longer history, you could really see how last year's numbers, just how low they were from a historic perspective. They got lower than, or very, very similar, I should say, as they did during the Great Financial Crisis and other times when markets were very depressed, like in 1990 when there was a recession. One of the dynamics in the market that we're tracking is the performance in large cap or mega cap growth companies compared to interest rates or the bond market. And we pointed this out in our last update that we've begun to see a significant divergence occur just about 5 or 6 months ago. So going back to the high in the market, late 2021, early 2022, we could see how both the purple line, which is the NASDAQ 100 index, and that represents the large cap growth companies, compared to the gold line, which is an ETF that tracks 20 plus year bond yields, treasury bonds. They were highly correlated. Both were dropping at a very similar clip as well. So unusual to see bond prices drop as much as growth stock prices did during that bear market, but interest rates were rising. So bond prices move inverse to interest rates. Bonds dropping mean interest rates rising. And then when the market hit the bottom late last year, both of these started to recover a bit. But right in here, say mid-March, again, right during that banking crisis, the divergence began where bond prices took another turn down and, in fact, are very close to their low of last year. But growth stocks surged during that time. And we pointed out a couple of weeks ago, why is this gap developing in the market and how is it going to resolve itself? Will it be with growth stocks dropping, in which case there's significant air underneath growth stock prices to drop to come back in line to where interest rates are? Or will bond prices rally, meaning interest rates will drop to close the gap, or some sort of combination of those two events happening? Well, in the last couple of weeks, we saw both drop, as you could see here, where bonds took another leg down. Growth stocks are dropping as well. So we want to watch to see now if these are back kind of in sync in terms of the directional movement for each asset class. And that, of course, would be very important for the overall market because these large mega cap stocks are the dominant players in the market indices, and pretty much the way that they move, the direction they move, is the direction that the S&P and these other important indices are likely to move as well. So in summary, the correction is continuing to develop. We feel that perhaps we're somewhere midway between where we were at the beginning of August and where the market might ultimately settle out during this correction. One of the obvious signposts of a market that's struggling a little bit is that it cannot rally on good news. There was some good news this week in terms of earnings reports, in terms of some significant, much anticipated speeches, particularly by the Fed chairman this week, that mostly were considered positive for the market, but markets were not able to rally. In fact, they sold off on those events. So we are seeing some selling pressure enter the market, and we would expect more than likely that to continue in this August-September time period. Eventually, and depending just how deep this correction goes, it could set up a good buying opportunity, particularly for a year-end rally. So we'll be monitoring our tactical indicators, our models, and continue to keep you posted on how this is shaping up from our perspective. That's going to wrap up this week's update. Thanks so much for watching, and enjoy your weekend.